Hello, Jim McLendon, President of McLendon Mortgage Company, and today I want to talk about the challenges that our industry is facing and how we can respond to these challenges to grow our business. I'm going to do this by providing you with a couple of ideas or strategies that are tested and proven by some of the realtors I work with. The financial storm that has hit our industry has been like none we've seen before. Foreclosures have created massive inventory while holding down values, and lending guidelines have tightened, making it more difficult for borrowers to qualify. We have a choice. We can put our heads in the sand and wait for times to get better, or we can use this as a chance to learn and grow, to challenge ourselves to find the opportunities and capitalize on these by developing new skills and mindsets. One of the challenges we face is how do we stand out to our clients? With massive inventory, the ability of buyers to go online and access listings through Realtor.com, and the overall access consumers have to real estate data, it's becoming more difficult to stand out. The trick is to not give up. Many times that person that never bought may have needed a second opinion on their financing or looked at the property with a new perspective, and maybe the transaction could have been completed. Well, I don't want you to give up. I want to provide you with the tools that will help get the buyer off the fence. And one of these tools is a new program from FHA known as the 203K Streamline Limited Repair Program. Now, I'm not talking about the traditional 203K. Anyone who may have been involved with one of these knows these loans were nightmares to deal with for everyone involved, the buyer, you the realtor, and even us, the lender. Now, in theory, the traditional 203K should have been a dream loan. The buyers were able to finance repairs and improvements into one loan. The reality was that the loan's a monster. There were minimum repair costs and standards, higher interest rates than a traditional FHA loan, plan reviews, specs, plan review fees, and on and on and on. The loan was also paperwork intensive, requiring mountains of paperwork for the buyer as well as the lender. And this, by the way, was one of the better 203K files. So like I said, in theory, the 203K should have been a great loan that allowed buyers to create their dream home. Instead, the program never took off. And it was no surprise. Many of us in the lending industry thought that all HUD had to do was ask for feedback and tweak the program so that it would improve. But we could never get a response from HUD. They must have been busy. Well, after the events of the last year, HUD has taken action, and the result is a new, friendlier 203K, better known as the 203KS Streamline Limited Repair Program, or Little K. Little K allows buyers to make limited repairs, which basically mean repairs that won't displace the buyer from the property while they're being completed, as well as include the cost of appliances into the loan. There are no minimum repair amounts, and the maximum repair amount is capped at $35,000. The loan is underwritten to standard FHA guidelines, and there are no adjustments or increases to the interest rate. And best of all, there's no meeting with plan reviewers or complicated plan submissions involved. Now you may be saying, this is nice, but so what? How's this program going to help me sell more homes? Well, let's say your buyers are looking for a home around $150,000, but nothing meets their standards. They don't like the kitchen counters, the carpet or flooring is ugly, or worse, stinks. The house needs new kitchen appliances, the windows are old, on and on and on. Well, with the Little K, you can address the buyer's concerns. All the buyer has to do is get estimates for the material and labor from a contractor or home improvement center and submit those items to the lender so they can be forwarded to the appraiser, who will then complete the appraisal subject to. The loan is underwritten and closed, and then the borrower has 3 months to complete the work. That's really all there is to it. Now, you may probably be asking, okay, the buyer got the house they want the way they want it, but what about the payment increase that's going to result if, say, they finance $15,000 in repairs? Well, this is a very important point to bring up. At McLendon Mortgage Company, we believe in educating the borrower so that they are aware of the benefits of home ownership. One of the ways we do this is by providing buyers with a report that allows them to see the total cost of different mortgage programs and compare these programs. This total cost analysis report enables us to educate the borrower on the tax advantages of home ownership and how they can leverage these benefits to better their financial situation. So let's assume our buyer was comfortable with a home in the $150,000 range, which really means they're comfortable with the payment for a house in $150,000. So when they meet with us, we do a thorough analysis of their financial situation, and in this case, we can figure they're in the 28% tax bracket and that they itemize on their federal returns. We utilize this information to show them that based on the property they're buying and the rehab costs, they're going to be able to deduct about $3,409 annually in mortgage interest deductions, which translates to about $284 a month. Now they can wait and get this money back when they file their taxes in the form of a tax refund, or they can use this information to have their employer adjust their federal withholding so they can increase their net pay by $284 a month. They can then use this additional money to offset the increase in their payment that resulted from the rehab. Now, of course, they need to verify this information with their tax consultant first, and we furnish them with this report so that the tax professional can review it. So what the total cost analysis report allowed us to do was educate the buyer and show them that by leveraging the tax advantages of home ownership, they go from having a mortgage payment that would be $93 more per month to actually reducing the impact of the monthly payment by $191 a month, which is the $284 increase in net pay less the $93 increase that resulted from the rehab increase in the loan amount. Now the report allows us to take this one step further. Let's say your buyer decides they want to utilize the full $191 a month savings they still have available to pay down the mortgage. Here are the results. Over here in the column titled Reduction, we can see that by adding the remaining $191 a month, they're going to be able to pay that loan off in just over 20 years, resulting in an interest savings of $67,164. Now let's recap what you were just able to do. You helped your buyers move into their dream home. You saved them over $66,000 in interest by leveraging the tax advantages of home ownership. How do you think they're going to react? You guessed it. The little K can allow you to sell more homes by helping your buyers see what is possible. In addition, our advice can make a real and lasting impact on your client's financial future. Thanks for taking the time to view this, and I hope this information was helpful. And as always, please stay tuned for more tips.